Hello value investors, thank you for joining me. Today I want to talk about Nautilus, the home fitness equipment company. If you haven't done so already, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why. So, Nautilus is a company that people have written to me asking me what are my views on Nautilus, have I changed my mind since the stock has sold off so significantly. So, I'm quite bullish on Nautilus, so I'm going to just go through, talk about its analyst day that it had back in March and how things have changed and what has not changed and what are its near-term prospects. Then we're going to talk about its valuation. So let's get started. So Nautilus kind of sold off slightly together with a lot of the high growth stocks back in February. But it had its analyst day in March, mid-March, and since that period, the stock hasn't really returned to favor with investors. So why is that? So the thing is that Nautilus was growing quite fast last year, but as it comes up to compare quarterly results year over year, it's going to look quite grim because, last year there were no gyms open, so there was a lot of sales coming through Nautilus. But right now, as it comes to compare year over year, gyms are reopening, and many places gyms have already reopened. And how many bicycles are people going to need in their house, right? So there's two different types of headwinds hitting the company, and there's a lot of uncertainty. And the company is not really putting out any near-time guidance to help investors figure this out. Now, if you look at how analysts are looking at the stock, the analysts are pretty much expecting negative year-over-year growth rates starting in the September quarter all the way through several quarters into 2022. So management put out this guidance. They're saying, okay, by 2026 we're going to hit 1 billion in revenues and we're going to be investing for growth up until that point. So we're going to reach sustainable operating margins of 15% at that point. So if you take that figure of 150 million in operating earnings and you look at the market cap of 500 million, kind of several years out, admittedly, but you're paying approximately 3.5 times operating earnings. So I think that's quite cheap. Obviously, there's a lot of uncertainty. This is just a management saying, okay, we think we can hit this. There's no idea if they can hit this. But I just think that investors are quite gloomy about that. Now, if you follow Nautilus closely, you'll know about its subscription business called Journey. Journey amounts to less than 10% of its business right now, and it's going to be less than 20% of its business by 2026. It is not a significant driver of its profitability. It's not a significant driver of the story. Okay, focus on that aspect. Now, the company is profitable already, so they're putting out guidance for next quarter of approximately 7% operating earnings. So it's profitable. It is not a high growth stock. It's in the best case, it's kind of be close to 0% growth for the next couple of quarters. So, but investors are too gloomy right now. What's more, 120 million of its balance sheet is cash. So it's if you take out the debt and if you take the debt and subtract out the cash, you're going to end up with a net cash position of approximately 120 million. So it is a lot of cash in its balance sheet. So I think that investors are just quite gloomy here, and it's not the next Peloton. It's not playing in that league, but it's not trying to. So anyway, hope you found this video useful. I'll see you soon. Bye.